Hello everybody, today we are going to have an educational session about the moving averages. Moving average is a trend following indicator and smooths the price historical data. It can't predict the future action but indicates the current trend. However, it is a lagging indicator as it is based on past data. Nevertheless, moving averages give you really quick the trend bias and decrease the noise. They are useful especially when you can combine them with other well-known indicators like RSI, MACD, and so on. There are too many kinds of moving averages, but the SMA, simple moving average, and EMA, exponential moving average, are the most common among traders. As you can easily understand that the bigger the number of moving average, the more the lag you get and vice versa. The length of the moving average depends on your profile as a trader. The bigger number, then you are targeting on long term, while the smaller number, then you are using more short-term approach on reading charts. Let's see on the screen. As you can see, we're using the 50 exponential moving average, which is much less than the 10 exponential moving average. Now, let us talk about the most common techniques for using moving averages. The first is recognizing the trend bias. Rising moving averages indicate bullish trend, while falling moving averages bearish trend. Let's see some examples. We are using one more time the 50 exponential moving average, and we can notice that how indicates an uptrend when is rising. As well, price is going higher. On the other hand, prices are going lower when the 50 exponential moving average is falling. Simple as that. Now, let us see the crossovers, which is the most popular way using moving averages. A bullish crossover happens when the shorter moving average crosses above the longer moving average, and vice versa. You can use double, triple crossovers, and in general depends on how much complicated you want to create your strategy. Naturally, this signal is lagging too, but it gives you a quick trend bias on your chart. In order to keep it simple, we are using again the 10 exponential moving average and the 50 exponential moving average. In this example, we can see a nice bullish crossover, which gave a decent upward move. On the other hand, in this case, we can see a similar bearish crossover. Going forward, the third method is the price crossovers. This is one of the simplest signals. When prices move above the moving average, a bullish signal is occurred. Once more, we have 50 exponential moving average here, and when price closes above and remains above the moving average, then we consider an uptrend move. Now, let's review the other way. Prices are below the 50 moving average, and we're having a downtrend, as you see here. Many traders are using more than one moving average, usually longer, in order to filter the signals and decrease the number of wrong signals. As before, we are using the 10 exponential moving average and the 50 exponential moving average. We consider as trend signals when price is closing above 10 and the quick moving average is above the slow moving average, as you see here in this example. Finally, we can use moving averages as a support and resistance, especially when following the current trend. This means that moving averages can also act as support in an uptrend and resistance in a downtrend. So this is a support for the uptrend, and here you see also a resistance for the downtrend. Everything depends on your trading approach. The smaller length like 5, 10 or 20, you will get more potential signals, and vice versa. Now, the most common moving averages are 10, 20, 50, and 200. Thank you for listening. If you have any questions, feel free to contact your account managers. Talk to you again very soon. Have a good time. Thanks. Bye.